market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, the deadly fires in Los Angeles have forced almost 180,000 people from their homes as firefighters struggle to bring the blazes under control. President Biden says the U.S. government will cover 100% of the costs of the California wildfires for 180 days, calling the devastation catastrophic.
So today I'm announcing that the federal government will cover 100% of the cost for 180 days. This is going to pay for things like debris and hazard material removal, temporary shelters, first responders' salaries, and all necessary measures to protect life and property.
Now, for more, let's bring in Bloomberg's Rachel Morrison. Rachel, how much progress are firefighters actually making to control the wildfires?
Yes, as you mentioned, for the first time, we're seeing some progress finally being made by the firefighters. So for days, the fires have been 0% contained, meaning they're continuing to spread. So the latest news, the figures for at least one of the major fires is that it's now 30% contained. And the extra bit of news heading into today is that the wind is about to drop. So that has really been fanning the fires and making them spread much more quickly. So obviously the firefighters will be hoping for some relief from that later today. And as we know and have reported as well, there's been a problem with water supplies that will continue to make fighting this really challenging.
Rachel, what more do we know about the damages and how costly it will be to rebuild all of it?
Figures are starting to come through. Yesterday, we were looking at figures of about $50 billion. Today, they're as high as $150 billion. That's from AccuWeather. And really, one of the biggest questions is whether people will be able to get money from their insurers for their homes. And a lot of that comes down to what has happened in the past. We know that a lot of these areas are very high risk and insurers have stopped a long time ago issuing new policies. So some people are either uninsured or under a sort of state form of insurance. So a lot of those costs for people's homes might not be recovered. But we're already seeing estimates for the cost for the insurance industry at about $20 billion. And that just keeps increasing, that number getting higher and higher as the fire just keeps engulfing more and more properties.
Rachel, thank you so much for the update. Rachel Morrison there. Of course, we're across this with Rachel and her team throughout multiple regions. Now, President-elect Donald Trump says a meeting with Russian President Vladimir Putin is being arranged. Trump has repeatedly said he wants to end Russia's war in Ukraine, raising fears any potential armistice would be favorable to Moscow, despite heavy Western support for Kyiv. Now, for more, let's bring in Bloomberg's EMEA News Director, Roz Matheson. Roz, thank you, as always, for joining us. I mean, this feels like a huge deal because unclear where they would meet. There was suggestion that they could meet in Mar-a-Lago, but what do we know about this possible meeting?
Well, it's very, very unclear. All he said is that something is being set up, and we don't know whether that's a phone call. We don't know whether it's an in-person meeting. As you said, obviously Donald Trump has made it a priority. He was saying within 24 hours, now he's saying maybe within 6 months to bring the war in Ukraine, Russia's war in Ukraine, to a close, or at least some kind of resolution. And that's very much on his agenda. And that does involve Vladimir Putin agreeing for a start and then getting some terms and conditions done that Vladimir Putin would agree to, and I guess kind of squeezing Ukraine in a way to agree. So how do they do that? Do they need to meet in person? If so, where? And of course, the last time they met in person in 2018, they had a big summit in Helsinki. That did not go so well for Donald Trump. So there is potential risk for him. I mean, meeting the Russian president in person, A, you've got to find a location where you can do it that's neutral, potentially. B, you've got to set some parameters for that conversation. And the last meeting, Trump was criticised because he basically accepted Vladimir Putin's assurances that Russia did not interfere in that election in 2016. And so it's all very fraught. There's very little we know. But again, it does point to the fact that Donald Trump really does want to get the Ukraine situation resolved.
And Roz, I mean, there's also media speculation that actually the Chinese are sending an envoy to the U.S. president's inauguration. I mean, this is highly unlikely. What do we know about foreign dignitaries at the inauguration?
Well, it's very interesting because there was a bit of chatter that Xi Jinping might get an invite to the inauguration. Of course, no Chinese president has pitched up for that moment before, but it sounds like some reports are that maybe Wang Yi, the foreign minister, or a vice president, Han Zheng, could go to the inauguration. Either way, there seems to be this idea of having a senior-ish Chinese official present for that, and that would be obviously a signalling moment of how they are going to try and reset the US relationship. Even though Donald Trump is very antagonistic on trade, in the end he's a businessman, and so China will be thinking like other countries, how can I manage that relationship from the outset? So seeing who turns up, see who gets the invites from Europe. There are talks, there's chatter that maybe some of the far-right individuals in European politics will get invites, heads of state less so. So who actually pitches up on the day? It's going to be very interesting to see.
Roz, what did you make of Jimmy Carter's funeral yesterday? I mean, it was quite amazing to see the the 5 former presidents being there. Jimmy Carter was the longest-serving commander-in-chief. And there was a bit of banter and joking around between Barack Obama and Donald Trump.
That's right. Everyone was trying to lip read and work out exactly what they were saying, and I saw lots of reports of what exactly they were talking about. I mean, it wasn't particularly relaxed banter. You'd have to say Barack Obama didn't look particularly comfortable sitting and chatting with Donald Trump, particularly, given everything that was said before the election between Biden and Trump. But it was a moment where, at least everybody recognised that Jimmy Carter was a lion, for want of another word, in US politics over many years, in a way even more so after he was no longer president. It's very hard to argue against, his humanitarian work. So he was a big figure, and in that moment, you all come together. So I would call that a very brief moment of unity in US politics, and a lot of disunity probably to come.
Roz, thank you so much, as ever. Roz Matheson there with the very latest on US politics. Now, coming up, with the UK becoming the focus of a global bond sale, I'll have Chancellor Rachel Reeves is under pressure to deliver new spending cuts or tax rises. We discuss the latest next. We also look ahead to US jobs data. This is Bloomberg. Welcome back, everyone. Now, investors adopting a pretty cautious stance ahead of U.S. jobs data later after a volatile start to the trading year. Now, here in the U.K., gilt yields climbing across the curve. The pound has fallen for a 4th day. Now, let's discuss all of this with Peder Beck-Friis, economist at PIMCO, and Themistoklis, global head of FX strategy and EM macro strategy at Barclays. So thank you both for joining us. First of all, I mean, just from a market perspective, it was like, wait, what? Everything was started in the U.S. because of a repricing of expectations of inflation, but it really infected the rest of the world, especially first gilts, but then sterling.
So I think you're hitting the nail on the head. When we're talking about any kind of bond market, even the UK, you have to understand this is a very bad setup for bonds, has been a very bad setup for bonds, particularly because of the developments in the US. You have much better data, you have strong, job openings, inflation expectations picking up on a number of surveys, and you obviously have the prospect of earlier tariffs, and the potential for fiscal easing, all of which is aggravating the bond market. And the UK, because of its demand and supply dynamics, has had a high beta to that situation, I would say.
Yeah, Peter, how would you describe actually the week that we've just lived through? And I guess there's quite a lot more to maybe do in terms of market routes, but is it a fundamental problem for the UK economy?
Well, look, lots of volatility in gilt yields, lots of near-term uncertainty. I think the background is global yields have increased over the last 3-4 months. That clearly puts pressure on countries with more fragile fiscal balances, UK being one of them. So lots of near-term uncertainty. I mean, I would be very surprised if the government changed the fiscal rules. I would be very surprised if the government did not adjust the fiscal variables to meet the fiscal rules. And I think in that context, if you look at the front end of the yield curve, 2-year point, 5-year point, I think yields look high and fairly attractive here.
But how would you describe, if you look at the UK particularly, is it 70% because of the US and 30% because of the UK, or is it really that the Chancellor hasn't given herself enough space, so that because the buffer is so razor thin, we're going to see these moves continue?
So I'd say the catalysts are 100% US, right?
Yeah.
The outsized move has to do with the fact that since the 2022 story, there's been a very big change in the demand dynamics, particularly in the pension industry in the UK, in respect to the absorption of fixed income. And at the same time, throughout this period of time, the supply side with a large deficit hasn't changed. So, you know, you have a market that is absorbing that supply less easily. And when you have a bad global bond environment, it reacts with a high beta. So the outside move is all UK. The triggers are all US.
Okay, what does the UK now have to do? If you're the Chancellor right now and you have to find just more money, is it more difficult to raise taxes than it is to cut spending?
Well, I think it looks more likely they will cut spending than raise taxes. That's the rhetoric that we've received from the Treasury over the last few days. But again, you know, I would be surprised if they did not adjust the fiscal variables, and I'm sure they'll find a way to meet the fiscal rules. So, you know, fast forward a few quarters, I think the markets will price in more fiscal credibility in the UK.
Peder, there's been a lot of talk in saying, like, look, this is a bit of a Liz Truss moment when we saw a lot of volatility because of mini budget. Others saying this is more like the 1970s debt crisis. Are they really comparable?
Look, I understand the comparisons. I think comparing it to the Liz Truss moment 2.5 years ago, I think today looks a little bit different. First of all, obviously back then we had an LDI crisis. That's not what we're seeing today. And more fundamentally on the fiscal side, we have a government now and a fiscal policy in place that will be tight over the next few years. And given the rise in yields, given the weakening growth outlook, I think the risk and the chances is that we'll see more fiscal tightening going forward. So it's a very different backdrop to what we saw 2.5 years ago.
Themos, what's investor perception of the UK right now? Again, as soon as you see yields move, but also pound weakening, you could argue that investors are just worried about not only growth implications, but inflation implications.
So we've had 3 switches in investor perception so far this year. We started
this year, 2025.
Yeah,
so 10 days.
Sorry, 2024. I'm sorry.
It's been volatile.
You know, haven't made the switch yet.
I'm the same.
Beginning of 2024, market was very bearish. Going through the elections, the prospect for you know, a rapprochement to Europe, market got more bullish. I think, you know, since the budget, the market has become a lot more scared, and at the moment, the market is turning a bit negative on the pound. Which we don't share, but, you know, it is where the market is.
But this is because, what, the budget was badly put together, or did she have an option, or is it more the fiscal rules that were, you know, are concerned because they tie themselves in?
I mean, I think that when it came to the perception that the budget was creating a lot more issuance with very little growth effect, given the projections that were presented, I think that didn't resonate much, didn't resonate too well for FX investors, for sure.
How do you view the fiscal rules?
Well, I mean, countries have different fiscal rules across the world. I think they serve some form of purpose. That said, the bond market will always make its own assessment of debt sustainability. The rating agencies will make their own assessment of debt sustainability. So more important, clearly, is the market's perception of the debt trajectory rather than fiscal rules. But having said that, of course, that constrains the government to some extent, yes.
Themos, we have jobs data of the U.S. today. How much will, again, that change the perception of inflation in the U.S., and therefore could it lead to more volatility in Europe?
I think at this point, the jobs data print today is crucial. We're at a point where, because we're restricting labor supply in the U.S. by immigration curbs, we're likely to start seeing slower payrolls growth. And if we get a soft print today, that could be a relief in the market that has been too volatile, moved a lot, too bearish. The main problem here is that the latest data, particularly Gilt, showed a pickup in demand, and initial claims fell as well, all of which points to a labor market which is still strong. As you're restricting supply, there's a fear that further down the line you could have wage pressures reemerge. So we are watching closely not only the decline in the level of the payrolls, but also whether that translates into strong and resilient wages here.
And there's also been a big repricing on BOE cut expectations, and that was early December. How much of that is that basically investors or markets looking at what the Fed does compared to actually looking at economic fundamentals of the UK?
Well, I think both. Obviously, the budget led to the front-end repricing higher. There's one risk that the market took, that the budget will lead to higher near-term inflation and put less pressure on the Bank of England to ease going forward. I think our central view is a little bit different. If you look at the underlying macro drivers in the UK, labour market slowing pretty sharply, growth stagnating. I think that will add more pressure on the Bank of England to ease going forward. And actually, recent events over the last few days, if anything, would probably add more pressure on the Bank of England to ease in the front end. Financial conditions have tightened. And to the extent we'll see even more tight fiscal policy going forward, that's also something that's probably a weigh on interest rates going forward.
But are you optimistic about the UK in general? We also have a story that PIMCO continues to buy some gilts. I know it's not your department, but overall, what does it look like for the next 12 months for the UK?
We've liked gilts for a while. We liked gilts after the budget. We continue to like gilts. I think it's a trade. You need to be patient. Fast forward a few quarters, fast forward a year, I think it's easier to think of scenarios in which gilt yields are lower than higher from here. And yes, we can speak about fiscal concerns, but just if you look at the front-end pricing, not much is priced for Bank of England given the weakening growth outlook, and that reinforces our view that we think gilts are attractive at these levels.
Okay, thank you so much for joining us. Peder Beck-Friis from PIMCO, Fiotakis from Barclays stays with us, and we'll talk a little bit more about dollar strength or weakness and what the president-elect wants. This is Bloomberg. Welcome back, everyone. We put the focus on FX. Still with us, Fiotakis from Barclays. Themos, we're talking a little bit before about yields, gilts, but also treasuries. I mean, we're 12 days away from the inauguration in the U.S. What do you think Donald Trump wants from dollar?
I think that what he wants is very different to what he's getting based on his policies, right? His policies, he has said that he wants a weaker dollar. His policies are all strong dollar policies. Now, I think that one of our biggest areas of focus in our research is tariffs. A lot of people are thinking of tariffs now in comparison to 2016, 2017. I think the setup is different. The administration now, as Lighthizer is expressing himself, view tariffs as much more of a functional tool which they want to use in a very broad way to support the U.S. industry. This is also a setup where for a few years now the trade war has been escalating with a lot of retaliation from China. We had measures even from the Biden administration in the end in the form of the Inflation Reduction Act and the CHIPS Act that basically supported the U.S. industry. So we expect tariffs to be a pretty significant tool for this administration, which they will use broadly. The recent articles highlight the notion of sector-wide tariffs, which can be a lot more powerful, a lot more effective, and they can have a lot more collateral damage in FX. Tariffs mean a stronger dollar, and I think that. Sorry,
is at the expense of others? So is your favorite pairing euro dollar because euro will suffer automatically?
I think Europe is stuck in the middle and is not reacting, so it's definitely the prime candidate. But there's a lot of collateral damage with sectoral tariffs. The yen, the Korean won, the Chinese yuan hasn't moved enough. They're all prime candidates for this.
So interesting. Well, I know we'll have a lot more conversations about FX in 2025. Themos, thank you as always. Themos Fiotakis, Global Head of FX Strategy and EM Macro Strategy at Barclays. Coming up, Elon Musk gives a platform to the far right in Germany ahead of the country's federal election. We have the details next. And this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Investors wait for U.S. jobs data as the UK sell-off continues, piling pressure on the Chancellor's economic project. Firefighters make some progress in controlling several blazes that have scorched Los Angeles as the death toll rises and more than 180,000 people are forced to flee. Plus, Donald Trump says a meeting with Russian President Vladimir Putin is being arranged after the U.S. president-elect pledged a swift end to the war with Ukraine. So Elon Musk's latest foray into European politics was a conversation on X with the far-right German election candidate Alice Weidel of AfD. Now, 3 of AfD's state chapters in the former communist East are classified as extremist and are under surveillance by Germany's domestic intelligence service. Let's bring in Bloomberg's Ollie Crook in Berlin with the details. So, Ollie, first of all, how did it go and what was discussed?
Yeah, so listen, Francine, it was about an hour and 10 minutes long, and I think the list of things that were not discussed was a bit shorter than what was actually discussed, because we talk about wide-ranging conversations and interviews. I mean, this really must have taken the cake. It really began on sort of energy policy, the sort of issues with the German economy, cutting back bureaucracy, the Merkel years, but then also, talked about immigration, the war in Ukraine, Israel, Adolf Hitler came up. There was talk about colonizing Mars for about 10 to 12 minutes of the conversation, as well as sort of their respective beliefs or not in the existence of God. So this was a really very wide-ranging conversation, and I think it was interesting to see how many people were watching throughout, because at its very peak there were about 210,000 people listening in, because you could watch this on the X platform, kind of the number of people that were participating and listening to it. I think it really sort of dropped down when they got into sort of nitty-gritty proposals on energy, but then rose back up when you started talking about immigration and some of the more sort of culture war issues. A couple of points that I think bear mentioning that probably require some sort of correction, because there were some sort of false statements made during this conversation. I mean, Elon Musk introduced her as the leading candidate in Germany. As we know, the AfD is not polling at #1. The CDU is polling at #1 with about 30 to 32% of the vote. The AfD is in second place with about 20% of the vote. I mean, another kind of very strange point was this sort of discussion that the fact that Adolf Hitler was not actually a far-right leader. They wanted to recast his leadership as actually being on the far left and being a communist, which is a fact that very few people who are credible and sort of with a perspective on history and within Germany agree with or could really stand up or validate. And also other statements that, like, for example, the AfD is the only party that sort of defends Jewish life within Germany because they're at such risk because of the Muslim population. Again, false statements. But really Elon Musk's ambition here was to try to sort of put her out in sort of as a very credible and sort of common sense voice on economic policy. I mean, at the end, basically reiterated the claim that he had made about a month or 2 months ago, saying that the AfD is the only thing that right now can save Germany.
I mean, does this actually change the perception for German voters?
Yeah, so listen, I think that this was really not geared towards the domestic audience in Germany. This was a conversation that was held in English. Only about 200,000 people sort of tuned in to it. I think the only way in which it might help the AfD domestically is that Elon Musk, if his stature as a sort of serious businessman and a sort of serious person on economic policy, gives more credibility to their plans there. But I really severely doubt that he's going to really change any major opinions here in Germany in terms of what the AfD stands for. Most people in Germany sort of know what they stand for and more or less whether or not they will stand by it. What I think it does sort of expose is a sort of rift that exists within the AfD. Alice Weidel is really trying to be a much more moderate voice and really leaning on some of the economic issues, the libertarian economic perspective that they have, and leaning much less on the sort of cultural side of things, where basically you have a party in the AfD that thinks that multiculturalism is a sort of failed experiment, that wants a much more aggressive and stronger sort of police state, and that basically says that Islam is incompatible with sort of German society. So really what she is trying to focus on is making this an economic conversation about libertarianism, but it's really hard to sort of deny and get away from the cultural side of things, which certainly lead to the far right.
Ollie, thanks so much. Oliver Crook there. We're a terrific roundup of exactly what happened yesterday and Elon Musk's foray or trying to influence politics in Europe. Now, TikTok set to appear before the U.S. Supreme Court in the last-ditch bid to avert a ban set to come into force on January 19th, one day before President-elect Donald Trump is inaugurated. Now let's get more with Tamlin Basin, a technology analyst at Bloomberg Intelligence. Tamlin, thank you so much for joining us. So what exactly is at stake for TikTok and its U.S. rivals?
Yeah, Francine. Well, for TikTok, it's more or less an existential risk, at least in terms of U.S. operations. If it can't succeed at the Supreme Court, then it will be banned come January 19th. For its rivals, that could create an opportunity for market share gains if TikTok is removed from the U.S. market. So firms like Meta, Snapchat could see growth if TikTok is removed from the U.S.
So Donald Trump has been talking about TikTok quite a lot, actually, and he said he opposes the ban. Does that matter?
Frankly, it might not matter all that much right now. And sort of the reason being is, as you said, the ban takes effect January 19th. He becomes president January 20th. And just the stage we're at in this saga, this was an overwhelmingly bipartisan bill that was passed by Congress. It goes into effect January 19th. And really, TikTok's only chance right now is to succeed at the Supreme Court. So we do know Trump has softened his stance on it. But at this stage in the game, it might not carry that much weight.
Tamlin, thank you so much for joining us. Tamlin Basin there from Bloomberg Intelligence. Now let's talk banks. And the top banks on Wall Street are also said to be planning the biggest bonus increases since the pandemic for traders and deal makers. Let's bring in Bloomberg's finance team leader, Jenny Serrain. Jenny, I mean, what details do we have on these bonus hikes?
Yeah, I think this year the magic number seems to be 10%. So that's what we've heard is in store for folks at Bank of America, JP Morgan, Morgan Stanley. In some cases, it's even higher. So at JP Morgan, I think we're hearing that the deal makers there might be seeing increases of as much as 15%. So lots of good feelings and good vibes among all the top bankers and traders across Wall Street right now.
I mean, does it give us an indication of what's expected for 2025?
I think so. Bonuses are kind of a funny beast because they're very backwards looking.
Yeah.
But I do think these banks are in a really difficult position right now because obviously last year was better than what we've seen in recent years, and we started to see that uptick in M&A. We started to see a real rebound in volatility for trading. But we're going into a period where a lot of people think we're about to see a huge surge in M&A, a huge surge in capital markets activity. And so this time around, these banks are really having to balance the fact that they want to keep this talent happy and keep these bankers in these roles. Even though last year might not have looked as good as what we might have wanted, they need to kind of still pay up in a sense just to make sure that they don't lose any talent and that they retain all their best rainmakers.
And this would be on the back of the Trump election.
Yes, exactly. Yes. So that's
what is
why,
it like deregulation? It's like all guns ho.
Exactly.
We're going to get M&A and IPOs.
Exactly. That's the big hope. So, I mean, we'll see. I think it's sort of interesting because I think the big expectation is the deregulation push and the fact that he's got much more friendly folks at the top of places like the FTC, the DOJ. We might not see as much pushback to really big mega deals, and that we see this big return. But I think, the proof will be in the pudding in terms of when that actually comes to pass. But certainly that's the hope and the ambition of all these bankers right now.
Jenny, thank you so much. Jenny Serrain there, our team leader for Europe and UK finance. Now, coming up, an exclusive interview, the president of the European Bank for Reconstruction and Development after a record-breaking year for investments. That's next, and this is Bloomberg. Welcome back, everyone. Now, investments made by the European Bank for Reconstruction and Development actually rose by 26% last year to a record 16.6 billion euros. Now, that's thanks to more support for Ukraine and green financing. Ongoing geopolitical risks, the effect of climate change, and Donald Trump's tariff threats are among the headwinds facing the lender's shareholders this year. Well, I'm delighted to be joined exclusively by Odile Renaud-Basso, the EBRD's president. Thank you so much for joining us. 2025 has started to be extremely newsworthy. There's quite a lot to understand in terms of foreign policy, in terms of what the world is headed. How much money do you have to invest this year?
So we have a lot of money we can invest. Last year we invested 16.6 billion, and I think that we have the capacity to continue at this kind of level of investment. Our shareholders decided last year to provide us with capital increase, so we have the capacity to continue to support our countries of operation, in particular Ukraine, but also all countries in need. And as you know, we will also start investing in 2025 in some sub-Saharan African countries.
Does it change? I mean, when you look at projects and where you decide to actually deploy money, does it change politically on what also government wants? So would it be more on, for example, reconstruction for war, less related to climate change, or how does it change in 2025?
So we expect, it's interesting to see what has been going on in 24 because I believe that some trend will be seen also in 25. And there is this big increase in green financing. We reached almost 10 billion of financing in the green sector. And what we see is a number of countries really accelerating on development of renewable energy, investing in the network. And this is related to green transition. I think there is an understanding and cost competitiveness because renewable are becoming much cheaper, but also energy security. So I think this trend will continue because we really see a lot of countries, for example, Uzbekistan, but also in the Western Balkans and so forth, taking up that kind of course, reconstruction will be a big theme for us and continuing to support Ukraine and adjusting to what evolves. I mean, there are a lot of discussion about, the geopolitical level, about possible negotiation, what could be a sort of settlement agreement. We don't know. There is a lot of uncertainty around there. But what is sure is that we will continue to support Ukraine in the war, but also in the reconstruction, and we are ready to step up and increase our level of financing in reconstruction.
On climate change, there are many question marks on whether the U.S. sticks to the climate accord. Does that make a difference to appetite, again, for some of the green financing projects?
I mean, the U.S. position, the U.S. is an important shareholder for us, so the U.S. position in our board, in the discussion likely to evolve, but I don't think that, I think the trend for investment and the understanding that this is needed, also when we see what's going on the real world and the catastrophe which are triggered by climate change. So I think there is this understanding by our clients, our countries, that they need to do something about it and that it's economically reasonable. We also see that in the manufacturing, industrial business, which are more investing in decarbonization of their processes than in the past. So we see acceleration in that.
For reconstruction, again, how does it change depending on some of the peace? I mean, you have geopolitically, and you say, we're talking about a possible accord between the U.S. and Vladimir Putin. Unclear if the two leaders are meeting or when or how. But does it slow down where you want to be invested in if there is peace or a deal, or do you go ahead until you hear otherwise?
No, it doesn't slow down. I think we will continue to support, Ukraine, for example, needs a lot of support in the energy sector. We will continue to do that. If there is some sort of settlement, ceasefire, then we can probably increase the level of investment even further, double it down or something, because then there will be more clarity, a bit less uncertainty. Private investors may be more proactively coming back and so forth.
What projects are you looking for in Africa?
So we are, Benin and Ivory Coast are the first country who have become member, and we are planning to 4 countries, additional 4 countries, which are Nigeria, Kenya, Ghana, and Senegal.
When you look at it, again, we're talking about tariffs and trade. This could lead to more inflation. Does it change some of the returns or some of the initial money that you have to put in projects across the world?
No, what we could see, depending on tariff, inflation, capital market development, and the cost of funding for sovereign, where we see a lot of volatility and so forth, this may have an impact on emerging countries. It's likely to have an impact on emerging countries. And then if their cost of funding, the role of MDBs, if cost of funding increase, if market access is more difficult, is to play a counteracting role, a sort of stabilizing factor. So demand for our financing is likely to increase if economic circumstances are becoming more difficult. Some countries may be particularly, affected if you have some across-the-board tariff increase. Our countries of operation are not the most dependent to the U.S. export and so forth compared with Mexico or some Latin American countries. They are a bit further away and not so dependent, but there could be some impact of course, global macroeconomic development.
When you speak to leaders across the world, especially in these countries that you're trying to support, are they worried about some of the uncertainty, volatility that we could see in markets?
Yes, it's also, they understand that it's important for them to stabilize. They have sound macroeconomic foundation. The stronger the country is, the better the budget is under control. They reduce the need for external funding and so forth, the better it is for them in that kind of circumstances. But I think they also, are confident the resilience of the emerging market economies in the last few years have been quite amazing. So circumstances depend on each country, but I think this makes the case, and it's also the conversation we have with them, for them to have very sound and solid policy agenda, reform agenda, and sound macroeconomic basis.
We also, this week actually, we spent quite a lot of time talking about the gas transit deal that's been stopped, which means that Ukraine will just get a lot less money than it used to because that gas is not flowing. Does that put them under more strain for reconstruction because they're lacking for that funding and money?
I don't think it makes, a huge difference. They needed, in any case, a huge support, and they will get in 2025 because things have been arranged already for them to get the budget support they need so as to support the IMF program. So I think it's not going to make a huge difference for them. And it's a political signal, I think, that they needed to take.
Can I ask you, as we get into 25, there's going to be a lot that you'll be dealing with. What's your number one priority? If there's one thing that you have to absolutely get right?
I think it's really addressing the needs of our clients and countries of operation, and really be agile and able to help them in dealing with volatile, uncertain times.
Thank you so much for joining us. Odile Renaud-Basso, they're the president of the European Bank for Reconstruction and Development. Now, we were talking a little bit before, and also with the president of the EBRD, about this possible relationship between Donald Trump and Vladimir Putin. We're just hearing from the Kremlin after we heard yesterday, rather cryptically, that Donald Trump will meet with Vladimir Putin. Mr. Peskov, the spokesperson for the Kremlin, saying, look, there's nothing concrete about this Trump-Putin meeting. This is according to the agency IFX. But Russia, he says, welcomes Trump's will to dialogue. He says they assume that both Trump and Putin are ready to meet. So we'll have plenty more, of course, on that story. Also coming up, the UK Chancellor, Rachel Reeves, embarks on a mission to deepen economic ties with China against the backdrop of market turmoil at home. We'll talk a lot more about that next, and this is Bloomberg.
It's Jobs Day, and Bloomberg has the report under surveillance.
I think this scene is familiar.
Wages are still robust. They're still growing. What does that mean for 2025?
Today, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
We're looking at a re-acceleration of how much people are earning and the hours they're actually working.
We count you down to the jobs report.
The December jobs report, today on Bloomberg.
Now, BlackRock says it's leaving one of the world's biggest climate investor groups after being targeted by Republican politicians. The money manager, which oversees more than $11 trillion, says membership of the Net Zero Asset Managers Initiative caused confusion regarding its practices. Now, BlackRock was amongst the asset managers facing a Texas lawsuit alleging breaches of antitrust laws because of pro-climate strategies that suppress coal production. And NVIDIA has criticized new export restrictions that are expected to be announced soon and were first reported by Bloomberg yesterday. Now, the company has accused the Biden White House of trying to undercut the incoming Trump administration by imposing last-minute rules. The looming changes could cap or would cap the sale of U.S. AI chips on both the country and company bases. Today, the UK asset sell-off continues, with gilts falling across the curve, with waning confidence in the government's fiscal discipline driving sentiment. Now, for more, let's bring in our UK correspondent, Lizzie Burden. Now, first of all, Lizzie, it fell to Reeves' deputy, Darren Jones, to respond to Parliament yesterday about all of these questions. Do we know how she's thinking about the situation, what happens fiscally?
Yeah, poor old Darren Jones, the Chief Secretary to the Treasury, his boss, Rachel Reeves, has jetted off to China to try and rustle up better economic ties with Beijing. So he had to stand up in the Commons and explain what's going on here. Take a listen.
It's normal for the price and yields of gilts to vary when there are wider movements in global financial markets, including in response to economic data. In recent months, moves in financial markets have been largely driven by data and global geopolitical events, which is to be expected as markets adjust to new information. UK gilt markets continue to function in an orderly way.
He also said that he couldn't afford a subscription to Bloomberg, Francine. And if he were a subscriber, and I would say it's on offer at the moment, he would know that the pound's been at its lowest level in a year. He would know that there are being comparisons drawn to the Liz Truss era and the period after the mini-budget because of this rise in gilt yields. Orderly isn't quite the language that's being used on the trading floor either. Citigroup saying that sterling's now the great British peso. Wells Fargo saying that there's room lower to go. In terms of the solutions that you're talking about, it was interesting, wasn't it, that we had this signal from Rachel Reeves before she went to China that she would choose spending cuts over more tax rises. But that's going to be extremely difficult politically.
Yeah, so Rachel Reeves also becoming the most senior British official to visit Beijing, and she wants to deepen ties after the week that she's had.
Yeah, I mean, conveniently off to Beijing, you might say. Her spokesman said that it was never considered, the Prime Minister's spokesman said it was never considered that this trip would be cancelled. Just to put it in context, Keir Starmer wants to reset the relationship with Beijing. He's not looking to return to the golden age of UK-China relations like you saw David Cameron trying to have with his pint glass clinking with President Xi. But it doesn't stop the fact that this is a really risky moment to be pursuing better economic ties. A focus, I should say, on financial sector opportunities. That's why Andrew Bailey's going. But look at the context for this trip. You know, we're just over a week away from Donald Trump's inauguration. We've already had members of his administration saying they don't want China to see this as a chink in the Western resolve. The new UK ambassador to Washington, Peter Mandelson, he's been a long-time advocate of better relations with Beijing. That might not endear him to the new administration. And then let's not forget the EU as well, trying to put pressure on China over the war in Ukraine. So it's a difficult balancing act, a lot of short-term downside risk for a trip that we're told isn't going to yield an announcement.
Yeah, maybe something on cooperation, including financial services. Let's see. Lizzie, thank you so much. Up next, to Bloomberg Brief, Danny Berger, Manus Cranny in New York, and this is Bloomberg.